Hello, investors. Welcome to one more monthly interaction with Canara Robeco. Uh, of course, this is also the year end, so time to actually reflect back on what has happened in calendar year 25 and how are we thinking about calendar year 26. Uh, when I look at calendar year 25, the year that has gone by, clearly was an year with hectic activity, a lot of complexity, a lot of challenges, and still the market has actually held on well. When you look at the year gone by, clearly there were global events and there were local events. So when you think of global events, you had tariff-related uncertainties, India being imposed 50% tariffs, you had continuation of Ukraine-Russia war, you had war between Iran and Israel, which thankfully did not escalate further. You had precious metals doing something that they had not done in very long period. Gold was up 60-70%. Silver was up more than 150% in the year. So clearly a year where there were a lot of global events. Coming to local side, clearly again eventful year. You had it started with the India-Pakistan escalation. You had the terrorist attacks. You had a lot of action on monetary side, whereby RBI did cut 125 to 150 basis point cut through the last 15 months. You had a year where government actually decided to finally, in a way, act and support consumption part of the economy through measures like the GST cut, through the measures in budget like the personal income tax cut, as well as the support at the state level through the social welfare schemes. On top of that, as an outcome of interest rate cut, you are going to get a boost on the consumption side. So you had many events to tackle with, or you had many events to look at through the years, both global and local. Having said this, it was also a challenging year where the corporate earnings remained muted through the year. In fact, 6 quarters in a row, the earnings were muted. And the FIIs actually turned net sellers. FIIs sold to the tune of $17-18 billion through the year on the market side. So all in all, quite a challenging year from Indian perspective. Despite these challenges, both global and local, the market did hold on well, thanks to the support from the domestic mutual fund and other DIIs and retail. The domestic flows on the market side was upwards of $80 billion. That ensured that the supply that came through the IPOs, QIPs, and FPOs was absorbed well. Just to put it in perspective, you have more than 2 lakh crore rupees of IPO through the calendar year. You had QIPs and FPOs which were put together roughly a lakh crore rupees. So a large supply of roughly 2.5 to 3 lakh crore rupees was absorbed through the domestic inflows towards the mutual funds and other products. This ensured that while the corporate earnings were muted and while the starting valuation was very high, we actually still delivered roughly 10% on Nifty, 5% on an approximate basis for the mid caps, and negative returns for small cap. So this was the year gone by. A lot of global, local challenges, but and high starting valuation, but at the same time, very strong domestic flows and supportive government and RBI policies, ensuring that we ended the year more respectfully than otherwise. So I think that that clearly is the starting point. When we look forward for the calendar year 26, clearly the starting point looks far better than calendar year 25. Most of the challenges, whether it is geopolitical challenges, as well as tariff related challenges, as well as monetary fiscal policy related challenges, most of the challenges seems to be either behind us or in the process of getting themselves resolved. The most important thing is the earnings were challenged, and thankfully the corporate earnings seems to be turning the corner. So when we look at last 5 to 6 quarters, finally in the second quarter and now in coming third, fourth quarter, the market is turning the corner. The earnings downgrades have stopped. So there hasn't been any downgrade at aggregate level for the market in last 3 months. And this has happened after the 6 quarters of earnings downgrade. So clearly the earnings have bottomed. The consensus is penciling in earnings recovery to double digit mid to high double digit during the financial year 27 and financial year 28. Clearly, the starting point for this calendar year looks far, far better than the last year. That's where we are in terms of how market is. The starting valuations also look far more benign than where they were 15 months back. We have had consolidation in market for 15 months. The valuations for large caps are looking fair. The valuations for mid caps are little elevated, but the earnings still continues to be healthy. Whereas the small caps still continue to kind of, in a way, struggle, given that the earnings recovery there is taking longer time than the large caps and mid caps. So that's where we are in terms of market. So clearly, the corporate earnings are turning around. Having said that, the valuation for large caps at 20 times and for mid caps, small caps at upwards of 25 times 1 year forward still remains not necessarily on an absolute basis very attractive, but on a relative basis, when we look at last 15-16 months, the valuations has corrected, given that there has been time correction whereby the market has been sideways through the period. So at least there are no excesses to start with in terms of valuations, and that's where the investor should actually have expectations in line with the earnings rollovers that are taking place. So as far as on an absolute basis the valuations are concerned, large caps are in fair valuation zone, mid caps, small caps still remain 15 to 20% expensive than their own historical valuation. In terms of sectors, clearly from our perspective, the opportunity remains on the domestic side. Domestic consumption across the value chain, right from auto till FMCG, in select financial, in fact almost all the financials, right from the banks to capital marketplace. In terms of industrials, very, very selectively, transmission and distribution plays, and a few of the other specific plays around defense. Then we remain constructive in terms of sectors on hotels, hospitals, aviation, telecom. Pharma is one sector which has underperformed, but the earnings continue to be reasonably good. The valuations have corrected, so that still is a constructive sector or overweight sector from our perspective. These are the places where as a house we remain fairly constructive. So when we look at portfolio construction, it's a predominantly overweight domestic consumption space, as well as some of the defensive spaces like telecom, pharma, and smaller spaces. That's how the portfolio construction is. So just to summarize, we had a year which was the 10th year in a row of positive returns for Indian market. Having said that, a lot of those returns came because of the kind of inflows that we had, despite all the challenges that we had on global front and domestic front. Having said this, one of the key things that clearly is changing is that the earnings have bottomed, the earnings downgrades have stopped. So while the valuations might not be extremely attractive, but they largely are coming to fair zone, and the earnings are recovering. Given this, we think that calendar year 26 has a better earnings valuation interplay from an attractiveness perspective as compared to start of the calendar year 25. Wishing all the investors a very happy new year. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.